Hello, and thank you for joining us for today's MacDesk Floor Report. I'm Rebecca Darst from the Market Access Center here on the floor of the New York Stock Exchange. The date is Thursday, August 2nd, and it's been quite a month already. A very volatile day in the major indices so far. When we got to the floor this morning, we were indicated decently higher, holding on to gains after the ECB left its benchmark interest rate unchanged at 0.75%, gains which remained intact even after an inline read on the weekly initial jobless claims, which showed a slight increase from the previous week's reading. The spanner in the works came as ECB President Mario Draghi's press conference got underway after 8:30 a.m. Here we saw an immediate spike in the euro-dollar currency cross to a pre-market high of 124.07. This was within a handful of pips of the 50-day moving average of 124.13, its highest level in nearly a month. Euro-dollar then reversed sharply lower, back down to the 121 range, where it has remained ever since, pressuring risk assets across the board. At issue is this. Remember last week's massive short covering rally, particularly in the euro, sparked by some read-my-lips style jawboning by Mario Draghi, who pledged that the ECB would do whatever it takes to save the eurozone. Market participants were looking for follow-through today in the form of actionable plans. Instead, the market was treated to more vagaries. Draghi saying that various non-standard tools would be reviewed, saying that the ECB may undertake outright open market operations, while acknowledging that Germany's Bundesbank is still on the fence, no kidding, and that the details of any new plans still need to be worked out. The eternal bugbear of any coordinated action in Europe. Traders down here on the floor and analysts we've been speaking with throughout the day regard this as a failure to deliver on the part of Draghi, having already been underwhelmed by the Fed's willingness or lukewarm willingness to intervene earlier in the week. BNP Paribas was out with a note this morning, noting that not only was there a lack of follow-through on last week's big talk from Draghi, but also a thundering absence of any other initiatives to compensate for the lack of firm bond buying. Jefferies, meanwhile, noted in their reaction to Draghi's comments that the market is taking this as an implicit acknowledgement that the ECB will not take decisive action until bond market access for peripheral Eurozone countries gets much worse. In any case, the market didn't like it. And while we're off the worst levels of the session, the Dow is still down about 150 points, and that's not a great setup, although the VIX is slightly lower at 1836. Looking ahead, tomorrow's big data point is the July change in non-farm payrolls number. And to that end, we've been seeing option traders dabbling in the SPY weeklies. As we mentioned last week, hedge funds have been using the super liquid weeklies to achieve more bang for the directional buck on these weekly data point releases, many of which have been soft this summer. Although remember, last week we saw buyers of the weekly puts and sellers of the calls ahead of last week's GDP reading, and this strategy did not pan out very well for the market bears, what with the Draghi-led short squeeze still going on. Today, as we mentioned in the midday, we've been seeing sellers of the weekly at-the-money puts, which may indicate expectations of a short-term bounce to close out the week. Which way will it go? We'll be watching the action as it unfolds here on the floor. For a complete look at the market action, be sure to check your inbox for the midday. For now, that's it from me, Rebecca Darst for the MacDesk Floor Report.